Welcome back to another episode with a friend and someone I'll be seeing. Well, I guess I'll see you, but this will be probably airing after the event. So I hope you had a great event and it was nice seeing you there. But welcome to the show, a new guest, a friend, and someone that we have a lot of respect for him and his group. You might recognize his face if you know Hunter Thompson, as we're in the similar communities. But please welcome to the show Tyler Lyons, CIO, Chief Investment Officer at ASYM Capital. How are you today?
I'm doing great, Craig. Yeah, and I appreciate the invite to come on the show. I think very highly of what you and Rob and Kent and the whole team at Lone Star, of what you guys are doing over there. I think you guys are very careful, conservative, smart, and sober investors. So it's a huge honor to be here with you here today.
You know what? I've never heard that phrase before, but a sober investor. And wow, did everyone get drunk on interest rates in this last part of the cycle, huh?
Yes, they did.
Yeah.
Absolutely.
Well, we're going to talk about a market that got very drunk on rates and got very hot. And now, no pun intended, because the heat and where you guys play, but the market got hot. It's cooling and changing. But those are the opportunities that you want to get in. And those are the opportunities where you want to speak with this guy right here because he might have the next best investment opportunity. But before we get into ASIM strategy, what you do at your role there, let's get into your personal story and how you got into the chair you are in today.
Yeah, sounds great, Craig. So, like many folks who are in this great real estate industry that we work in, I didn't start my career in the world of real estate. I don't come from a real estate family. I didn't have a real estate job right out of college. My first role out of college, I actually worked in the world of accounting and corporate finance for many years before I got into the world of real estate. So, I got my CPA right out of college. I worked for a big four CPA firm for many years. And after that, I then made the switch to the other side of the ledger. I then worked in the accounting and corporate finance function for a large publicly traded company. And it was going pretty well there. I started to kind of climb the corporate ladder. I got promoted young and I was overseeing SEC reporting, accounting, and internal controls for a pretty large publicly traded company. And I had this pretty good problem going on where, I was still young. I kept my expenses low. So I was maxing out the 401k and I was starting to build up some cash savings. So I started to wonder to myself, like, okay, what do I do with this cash savings? Like, what should I do? Like, where should I invest? Should I start a business? Like, all these questions started to pop into my mind. So it kind of sent me on this journey of personal education just to dig into that a little bit more. So I really dug into a lot of books, a lot of podcasts, did a lot of just personal self-reflection too, to try to figure out what I wanted to do. And eventually I decided, you know what? I'm going to take that cash savings and I'm going to buy an investment property. And mind you, this is when I was very junior in my real estate career. I was just learning about the world of real estate. I didn't know what a syndication was. I didn't know that you could own a proportionate ownership interest in these big apartment buildings.
And
I had
have someone
no
do the
idea.
work for you, right? And
Right.
manage it and not change your sinks. So what year
Absolutely.
was this roughly, just for context too? I think it's
It's
always
about,
interesting to know.
yeah, it's about 2015, 2016 or so.
Good entrance point into the market.
Absolutely. Absolutely. So I started buying these smaller residential properties because, again, I didn't really know any better, but I started to kind of build up my portfolio. And as I kind of built up my personal portfolio, I started to fall in love with the industry more and more. And eventually I found the world of syndication and learned, okay, I can invest passively. Like, maybe I should try doing that. I started investing passively into real estate. And as I saw the world of syndication as well, then it started getting my antennas were up around potentially starting a business. It's like, okay, with my institutional background in corporate finance, I think I can do this kind of stuff. Like, that's kind of where my mindset was at that point in time. And at the same time, I was kind of starting to fall out of love with the day job a little bit too. And eventually I kind of got to a breaking point where it's like, okay, I've had enough with the day job. Like, I'm ready to do something different and I'm ready to burn the boats. And at that point in time, I had met Hunter probably about a year or so prior to that. And I remember having some conversations with him and just ideating on it. He has a friend, he has a mentor at that point in time. I was really kicking around like, look, what do I do? Do I go and start my own syndication firm or my own fund? I had some other opportunities that I was looking at potentially to be a CFO of a pretty decently sized senior living operator. Like, that could be a good segue into the real estate world while leveraging my existing skills. And eventually, the way that conversation shook out is, Hunter approached me and said, hey, look, the timing here is very interesting because I'm actually in the process right now of looking to grow and scale ASYM Capital and take it to the next level. I'm looking for somebody senior like you who could potentially be groomed to be a partner of the firm. Is that something you might be interested in? So long story short, I ended up accepting an opportunity to join ASYM Capital a little bit over 3 years ago. And since I've been at ASYM Capital, it's been very interesting and very exciting. I've been involved in some pretty significant strategic changes at the firm, which I think we might touch on here at some point in time today. And this career has also taken me from Michigan all the way across the country. We're practically neighbors now in the Phoenix Valley. So it's been it's been an awesome experience. Even though I came into the industry at a point in time when it was a little bit of a difficult time with this crazy rise in interest rates and subsequent distress on deals and tight deal flow, all that kind of stuff, I know I'm in the right place because I'm having more fun than I ever have professionally. And it's truly a blessing.
Without a doubt. Well, it's funny. I think you and I have a lot of parallels in that regard, where we kind of came in very similar time periods. I came in 2022. If my math serves me correctly, did you kind of start working with Hunter around 2021 or 2022, early time frame roughly?
Yep, 2020, mid 2021.
So how did you find Hunter out of curiosity? Was it through LinkedIn? Was it through kind of his channels? And how did that kind of conversation spark, if you will, there on your guys' end? And can you kind of unfold and talk about that relationship there and how it kind of manifested into what it is today, where he felt comfortable with bringing you on at such a prominent role within the firm itself?
Yeah, absolutely. Yeah, I've always been, for a long time, I've been a podcast junkie. I love podcasts. I self-educate on podcasts. The first real estate property that I ever bought, it was pretty much all just from podcast self-education for the most part. I didn't really have much in terms of mentors. It was just books and podcasts and just learning stuff on my own proactively. So through that process, as I started to learn the world of commercial real estate, as I got interested in the world of syndication, eventually I found the Cash Flow Connections Real Estate podcast, which, Hunter has ran for many years now. And I found the podcast. And at that point in time, this was a precursor to the Raise Masters mentorship program. But I joined the CFC mentorship program back in the day, kind of the old school Hunter mentorship program.
Yeah,
So I got to
phase
know him
one.
through that. Yes, exactly. So I got to know him through that. And, through that program, we had weekly calls where you could kind of come in and ask what kind of questions that you had in your business. And I was always really engaged. I like to think that maybe I showed pretty well in those calls and in our one-on-one conversations too. And, with kind of my resume and background, I think he had a lot of confidence in me. And then also before I actually joined ASYM Capital, he hired me to do some consulting work on the side to help him analyze deals and underwrite deals. So he also got some firsthand knowledge of kind of my horsepower and kind of how I operate before I actually started working with him. So that was kind of the dating before we kind of eventually got married, and I just kind of joined the firm with him.
Very cool. And that was probably before the wife and whatnot, before Hunter's baby was born. So a lot has changed. Did you guys have a pretty strong personal relationship as well prior to kind of joining forces together?
We definitely did, Craig. And that was one thing too that's really important for me as I evaluated these different opportunities, is that him and I saw eye to eye on a lot of things just when it comes to even just beyond the way that we view the real estate industry, because we think about the real estate industry very similarly. We think about this industry in long term in terms of decades, the way that we think about investing, the way that we think about building relationships. We both have a very long term mindset from that perspective. But even just like when it comes to personal stuff, just how we view the world, some of our personal interests and hobbies, like we really just like hit it off on a personal level too. And when you have that kind of relationship with somebody, the trust is just so inherent that it wasn't something that I had to worry about kind of leaving behind this like big corporate finance career to kind of make the jump into real estate.
Yeah, I think you have so many parallels, and that's why I'm really appreciative that you got to tell that story there, because I personally didn't know it, but it's very similar to what happened with Rob and myself. Obviously, we maybe slightly different roles, and we'll get into exactly what your day to day looks like. But it's very interesting because similarly, I was very close personal friends with Rob, so I knew how he operated. I knew he'd be a great boss. I knew, and by the way, he is my boss, although we're friends. He's a couple years older, of course. He is, giving me marching orders, and I happily take them. But like you, I had options in a successful career prior to joining Lone Star. I had to be really wowed and be like, I see a great growth and vision for me to kind of leave what I was doing to kind of join more of a startup than, a proven commodity, if you will, to get out of not having a boss because I was doing residential real estate, having my own schedule, my own day to day to go to Lone Star, which is just a totally different animal, right? So I'm sure similarly to you in that regard, you had a lot of great suitors, a lot of good options, but you had your pivot point to get into real estate. I was in real estate before, but you probably had some pretty good, opportunities that were, successful. You obviously mentioned the senior living one, so you must have been pretty wild and felt pretty confident in Hunter as a person.
Yeah, definitely. And one thing that was kind of interesting, Craig, I'm not sure what kind of like what you felt or what the emotions were like for you as you kind of made the change from what you were doing to what you're doing now. But, for me, I invested so much into my career up until that point in time, like 15 years of just really hard work and climbing the ladder and thinking that I had this vision for being a public company CFO someday, like thinking like that's what I was aiming at. And then kind of like coming to the realization, like, you know what, that's not what I want. I'm lying to myself. Like I want something else. So making that change, it was kind of tough emotionally. It felt it's almost like breaking up a long-term relationship or something like that, like it was kind of a bit of a trying time for me while I was excited for the future. At the same time, you're always a little bit sad about what you're leaving behind. But then once I got into the industry, it's like, holy cow, I really was lying to myself because this is so much fun. And this is truly what I feel like I belong on this earth doing.
This is something that I've never spoken about on any sort of airing or recording, but to your point, if you get into residential real estate, it's a business that there's no money to be made in at first, right?
Yeah.
So for you to leave a business where you are completely autonomous, and if you can get that going, which very few people do, the average real estate agent sells like a house a year, quite literally, which is, not enough to keep the lights on, trust me.
Yeah.
So, and this is not a house a year in Malibu where you're selling a $20 million house. These are typically speaking $500,000 units here, which is a nice paycheck, but you got to have those coming in. So if you get that going, it's something you really don't let go of. Most people who are doing well, I was a top 1% agent for 2 years in a row. So to
Wow.
leave that, I felt really good, and I never doubted my decision. There's certainly a couple days early on, I was like, wow, like it's kind of like you really achieved exactly what I wanted to do. I kind of from birth, I don't know why I wanted to sell houses. I love flipping TV channels, ESPN. That's what I was watching growing up. So funny to get into the place we're in right now, where oh yeah, now we're kind of in the private equity side of things, but like that was really never my vision. So it's nuts to kind of have that dream, realize it, have it, and then say, oh well, there's actually something better around the corner, which is just the unpredictability of life itself, right?
Yeah, absolutely. Yeah, really helpful color commentary there for sure.
Yeah. On your end, what kind of got you most comfortable? And I guess, if you have any message for anyone who's younger, because we do have some people that are, maybe in college or just out of college or, kind of looking to get their start in real estate. You're obviously with 15 years of corporate experience, transition into something where it's a little bit more of a, I'm not going to say startup, but, kind of a scrappier environment, if you will, less established, not a big corporation. What would the advice be there? And do you have any blueprint or roadmap you could maybe provide anyone with, or because I kind of feel like it's usually pretty unique and organic how it works out when it does.
Yeah, that's a really good question, man. I think that my advice here might be a little bit contrary to what some other people might offer up because I definitely know that there's kind of like a hustle culture out there, and like people might tell you like, hey, like burn the boats right away, like chase your passion, like that's not my message, Craig. My message is more. I think you need to. I think you need to embrace the grind and build skills that are valuable because you need to have some sort of value proposition in the industry in order to have success. So be careful with kind of the chasing your passion sort of advice, like really kind of get out there and grind. And, if you're not in a work, if you're not in a role right now that's real estate related, but you've got aspirations of getting in the world of real estate, critically examine, what your skills are right now. Like, look, maybe you're somebody like me who has a background in accounting and finance, like stuff like underwriting and operations is probably going to come pretty natural to you. So how can you get out there and start sourcing deals and underwriting deals and working on those skills and honing those skills? Maybe you're somebody like Craig who's got more of a sales and marketing sort of background. Maybe you can get out there and start learning how to raise capital and start building a marketing machine. Maybe you're a consultant and you're good at project management and that sort of thing. Maybe you can partner up with other people and you can be more of the asset manager and execute the business plan. So that's what I would say. I would say just be very careful to just burn the boats and just jump into something, hone your craft, harden your skills, because the more that you do that, eventually you're going to have some skills that are going to be in demand in the marketplace, and then the marketplace will speak for you. Once those skills are kind of ready to rock and roll. So That'd be
Yeah, and
my
I have a
advice, Greg.
yeah, those are really great tidbits. So I want to echo that and kind of put an exclamation point or emphasis point, like if you're doing an iMessage where you can kind of highlight something, that right there. And in conjunction to that, I'll also say that it's really important to develop good habits and to be a good thinker and to be independent and self-sufficient. So all that's to say, developing skills, because your skills will be transferable. You don't necessarily know how they will be transferable, but residential real estate's not multifamily real estate. But there's a lot of stuff in the day to day, like coordinating logistics, following up, being just good, being on it, just making yourself available. That is always going to be in demand. So that can always be there. So thinking of things like that are super crucial, but just showing up day in and day out and realizing that, hey, you're not gonna, get to the finish line right away. It's a journey. You go up, you go down, you zig, you zag, but you will get there if you keep kind of moving it forward.
Absolutely. And it's kind of cool that you and I are both having this conversation here too today, Craig, because you and I both are, I feel like we're pretty good examples of people who've been able to retrofit our skill sets to be able to be effective and participate in the industry. So, yeah, just because you're not in the industry now doesn't mean that you don't have a pathway there. It might take a few years of diligent grinding and experience. I mean, for me, I knew pretty early on after I started buying real estate that I wanted to have a business in real estate. I wanted to be full time in real estate. And it took me, 5, 6 years to kind of get there and fully make that plunge. So it might not happen overnight, but one thing I've noticed about people in the industry, in the real estate industry who have a lot of success is they're persistent. I think that's one of the most crucial characteristics of people who are successful in real estate is people who are persistent. So if you're willing to just stick with it, and like you said, Craig, like keep showing up day in and day out over a long period of time, you can make it happen. Like this industry isn't rocket science. It's a hard industry, but it's a hard industry because it's like these very simple things that you have to do just over and over and over that not many people want to do.
Yeah,
So
without a doubt. But they're easy little, repetitive things. So, I'm used to only eating what I'm killing, which means if I'm not selling anything, I'm not doing well. So I have that internal clock kind of all around my brain. But the two things I took note of when you're speaking and, absorbing what you're saying, two words I have in mind, which is be nimble and be able to pivot. And that's basically just being adaptive. You want to be nimble and sense that, hey, you're not too tied down to something. You don't have all your eggs in one basket where you can't pick up and move. Be nimble, be quick. I mean, you moved from freaking Grand Rapids, Michigan, if I'm not mistaken, to
yep.
Phoenix because the opportunity presented itself. And then also you made a pivot. You went from, it's obviously complementary, but it's still a pivot, just kind of like myself there as well. So I think we're incredibly relatable like that. And then I think you said something else in the previous statement, which was just to reiterate this once more. If you have good skills, you follow up and show up, the market will find you. The market will reward you. So maybe it hasn't happened today, but it will happen over time. So just remember that when you're going through your process. If you're not where you want to be today, that doesn't mean you just throw in the towel. It's like, no, you keep going, but you have your eye around the corner as to what might be next. See around that corner, see what the next move could be. So I just wanted to kind of touch on that once more. And speaking on and transitioning into ASYM Capital side of things. So you mentioned you're the CIO, Chief Investment Officer. So what does that specifically mean? Because, to certain companies, it might be certain things. So I'd love to kind of understand your role specifically within the company and how that works throughout.
Yeah, and this great question, Craig. And one thing that this kind of ties my role and what I do. It ties back into the conversation of when I first joined ASYM Capital, like Hunter and I like really getting to know each other on a deep level. Because when you think about ASYM Capital and what I do and what he does, it's kind of your classic visionary and integrator sort of relationship. Like, I'm not sure if you've read Traction. For the listeners who haven't, you should. It's right here on my bookshelf behind me. But we've got kind of that classic, he's more of the visionary, I'm more of the integrator sort of relationship. So at ASYM Capital, I'm responsible for more of the operational related matters of the firm. So asset management, acquisitions, even more of the administrative side of investor relations, where he's involved more with kind of like the big picture strategic thinking, marketing, capital raising, that side of the business. So that's kind of how we would bucket it. But when we were getting to know each other, like that was another really big selling point for me, Craig, is that we both did a disc assessment and we got together and kind of compared notes. And we could kind of see like in terms of like how he was skewed on the disc assessment, how I was skewed on the disc assessment. It's like, holy cow, like we've got completely different skill sets that are totally complementary. So when you look for a business partner, like I think that'd be my advice for people. Your tendency, if you want to partner with people in this industry, your tendency is going to be to want to partner with people who are like you. like your friends and whatnot. I think about some of my dearest friends that I have from like back in my accounting days. And there may have been a time where I was tempted to do business with them, but it's like, look, we've got like the same skill set and our brains work the same way. But with Hunter and I, it's kind of like completely on the other side of the spectrum. So that's kind of how we break up the responsibilities. And it was kind of an interesting selling point for me when I thought about joining ASYM Capital as well.
Yeah, I mean, Rob and I are very, very similar, kind of like you and Hunt are in many respects, as you alluded to. But what we want to do, what we want our days to be like, and kind of how our brain and energy flows and works is wildly different. Rob wrote a
Yeah.
book on underwriting and debt and equity structuring. I can barely read a book, just kidding. But I'm a talker, I'm a schmoozer. I like to do stuff. I'm an extroverted guy, okay? So I do the outbound stuff, I do the calling, kind of some of the hype there, if you will. And I'm not the one that's underwriting doing asset management or, kind of money in, money out. I have a very specific niche role there, but it's so crucial, as you alluded to kind of find the right fitting glove like setup because you do not want to be with someone who does the same thing as you. That's not complementary or value additive.
Yep. Absolutely.
So then what does your day to day look like? I mean, obviously this world is wildly different. One week I might be worrying about the summit event, and then raising capital the next, and then setting up meetings for a conference or researching people. And then, there's no 2 days look similar. Then I could be recording podcasts, right? So I'm sure for you wear different hats, but, on a, I guess in maybe a typical month, what are kind of the roles and responsibilities that you share there and hold?
Yeah, absolutely. Yeah, so definitely leaning in pretty big on the acquisition side. Our analyst Bobby does the first pass of
Great
all of
guy.
the underwriting for us. He is a great guy. He's a rock star. We're just blessed and grateful to have him for sure. But he does the first pass and all the underwriting. So him and I spend a lot of time putting our heads together on the underwriting side, reviewing the models, reviewing the locations, like figuring out like where we want to try to go and acquire deals. So that's definitely a big part of the role for sure. On the asset management side, we've got some projects that we asset manage. So I'm in asset management calls here and there as well. So definitely leaning into that side of things. And then also a lot of the boots on the ground relationships here in Phoenix too. I'm getting together with brokers fairly frequently for, coffee, golf, lunch, happy hour, that sort of thing. So really building a lot of the local relationships here with property managers, vendors, brokers, everybody that we need to be connected with to be able to buy, operate, and execute the business plan on these deals. And then the last side would be even on the investor relations side too. I've got some involvement there, and I'm not having calls necessarily every day with an individual accredited investors, but a lot of my conversations are with some of the bigger kind of joint venture partner, 20, 30, $40 million equity check sort of people. I'm engaging those people quite a bit for conversations to look at deals together and, invite them to town to kind of hang out, like do like that sort of thing. So
Relationship building, yeah.
absolutely. Absolutely. So in terms of like, and then I do stuff like this periodically as well. I'm a host on our podcast. I've got a weekly episode that I host. Every now and then I pop on as a guest on shows like yours. Not that often though. I'm usually on the other side of the microphone. But when you and Rob ask for a favor, like I'm always happy to talk with you
Well,
guys.
we need you. We need you on the platform, right? We're too good of friends to not have you spotlighted.
Absolutely. Absolutely. But yeah, that's a pretty good encapsulation for what kind of my week might look like.
Yeah, I mean, I can't imagine a larger green flag if a group is coming into town and they're speaking with you because you're such just a stand-up person, steady, focused. Like that's exactly what you'd want to see. Not too old where you're entitled, but not too young where you're not experienced. You don't have a baby face, you have a nice beard. If I could grow one, I would, but I can't. So here we are. But that's exactly what you'd want to see in someone in your position. So I'm sure that's very reassuring for many of the partners that you work with, right? And then you also mentioned as well before we got on, just something you wanted to harp on, and I would love to hit on this too, is the shift that happened a couple of years ago to now, which is going away from more of a capital allocator fund manager kind of place to being the sponsor and lead GP. So can you kind of talk about that, the transition and kind of the whole inception of that, if you will, please?
Yeah, absolutely. So yeah, when I joined ASYM Capital, while it is a, bit of a smaller, scrappier firm, it is an established brand. It's a brand that people know. Hunter's been in business for over a decade now. We've been around. We've had the pleasure of working with over 500 accredited investors. And before I joined the firm, I think we had raised something like $70 million or closer to $90 million now. And, historically, what we did at ASYM Capital is we took a bit more of a diversified sort of approach where we would find really good sponsors and interesting niches and great markets. And we'd basically diligence sponsors and diligence deals. And we had partnered in those deals by being more of a capital allocator or capital raiser, but not really being the lead operator or the group that's actually controlling the deal. So Hunter did that, and ASYM Capital did that very successfully for many years before I joined the firm. And when I joined the firm back in 2021, one of my observations pretty early on was like, hey, look, we can raise quite a bit of money. Have we considered doing our own deals? Like, why wouldn't we want to try to go and be the lead sponsor? And it was interesting to me too. It actually wasn't that hard of a sell with Hunter because that's something that Hunter was already thinking about too. And I think part of it, he was looking for a partner like me to kind of like really oversee the operation side before he is really before he is really ready to make that leap. But also another thing that was kind of interesting is that when I joined the firm back in 2021, that was when multifamily transaction volumes and valuations were just getting really, really crazy. And the competition was insane. So we kind of step back and look at it. And it's like, well, we crave to have more operational control. We feel like if we do, that's going to just verify and validate that we can just take better care of our investors. We know we're going to do the right thing if things get sideways, if we're the lead and we own the deal. So we had that desire, but the market was so competitive at that point in time. It's like, man, if I called the broker in Phoenix right now, I probably wouldn't even get a call back. But then we kind of saw interest rates went up quicker than they pretty much ever have in history. And the market completely shifted pretty much on a dime. And it went from brokers being crazy with their hair on fire to, holy cow, transaction volume in our market has decreased by 80% from the prior year, and deals aren't trading and it's slowed down massively. So we viewed that as the perfect opportunity. It's like, okay, if we are going to make this pivot, now's the time to do it. And as part of that, I moved across the country from Michigan down to Scottsdale with my wife and our awesome little dog. And we've been down here for a little bit over a year now, but it was kind of a confluence of a few different things. Like we craved that control. Like Hunter's got a ton of industry. Like we're senior. We kind of know what we're doing here. And it was really just looking for that window of opportunity for it to be the right time to do it. And the market just presented us with what we feel like is an amazing opportunity and arguably maybe the best buying opportunity that we've seen in 10 or 15 years. And I feel like the properties that we buy right now are going to be, when we get out to 2028, 2029, 2030, people are going to look back and be like, wow, 2024 was a good vintage to buy real estate. I feel pretty confidently in that. So, kind of the desire and the timing and everything really kind of came together for us. And we made that strategic shift a couple of years ago.
So were you on the team when you were bringing in funds to other people's deals at that point, or were you kind of in that period of phasing out from your old life into the new life?
Yeah, I was on the team at ASYM when we were doing more equity allocation. And at ASYM Capital, we've done pretty much every structure you can imagine under the sun. We've done fund of funds. We've done co-GPs and joint ventures. And there's even a point in time where Hunter and I were both licensed as registered representatives under a broker dealer. And we're doing direct equity placement that way. So yeah, we were doing just kind of the pure play equity raising when I first started. And then not long after that, we made the strategic shift.
Yeah, well, I mean, obviously, I think if you can do the GPing and whatnot, any of the want and desire to, that is probably the route to make most money, have most control, and most, I guess, probably staying power as well. I think a lot of times that, obviously there's a lot of people that successfully raise, but there's a lot more of a moat around your business. I would say if you are, in fact, the lead sponsor, but not everyone's gonna be a lead sponsor. Not everyone wants to do that. Listen, I don't want to operate. I don't want to do asset management and property management. I want to do the fun stuff like this, right? I want to go to the fun dinners and take people out. That's what I want to do. But if you can do the sponsoring side, there's probably a bit of more of a staying power feel to that, with all due respect to it. So it's cool that you guys did, in fact, do that. And what would you say the biggest, on that note, the biggest difference was going from, hey, we're from the capital allocator to the sponsor now? Because I have to imagine it's tough to convince anyone to do your first deal together. But the beautiful thing is that when you work with Hunter, it's not like really doing the first deal because there's such a moat around the relationships you have due to the mastermind and whatnot.
Yeah, that's a great question. And just to put a little bit of a finer point on, actually, yeah, let's go ahead and just kind of jump to the next one here. So yeah, it's a great question, Craig. And there definitely was a little bit of an adjustment for sure as we kind of went from capital allocator to more of like the operator side of things. And there were definitely skills that we had to learn as an organization. And it wasn't that bad because as a capital raiser, and we've been involved in some deals too, where we did have to lean in quite a bit, even though we were a capital raiser. I mean, we've got a very good track record we're proud of, but you get a couple deals that aren't going exactly to plan. And there might be
Which
situations where even though you're a capital raiser, you've got to lean in a little bit and really push the sponsor and advocate for investors. So even though, for example, we maybe didn't underwrite deals on our own, or maybe weren't asset managing deals on our own, we were so close to a lot of those deals where we had a really good flavor for how that stuff works. So yes, we had to kind of build a process to source and underwrite deals. We had to build some processes to asset manage deals, but it really wasn't all that bad. I would say the biggest difficulty for us there, Craig, was probably it's more of the relationship side, and in terms of the relationships in the local market, because we kind of came in and it's like, okay, we're need to sell ourselves to these brokers that we can kind of buy and close these large deals. Like there was some hurdle there, but a big part of us overcoming that hurdle is I relocated here. I'm spending time with those guys week in and week out. They know, like, and trust me now. Like we've kind of overcome those difficulties. But there are some things that we had to learn, but that was probably the biggest piece of it. It's more of like the local relationship aspect, because that sort of stuff, it's really tough to shortcut that aspect of it. It really just takes time and repetition to really build those relationships.
Yeah, and I think for people who don't understand necessarily how the business works, just kind of a high level overview. If you are a broker buying the deals you're buying, what is the smallest, I guess, dollar figure in unit size and the biggest dollar figure in unit size you'd go before I make my comment?
Yeah, so the smallest we would go is about 100 units, because the smallest deal that we want to do is one that's going to support two full-time people, one inside and one outside. So that's really about as small as we want to go. And with some of the recent equity partner relationships that we've built recently, I feel like we can go, I wouldn't say unlimited on size, but we don't really have, I honestly don't even know what our cap is. Like we can go really big at this point in
I
time.
imagine you could bundle up into $100 million deals if it was two deals stacked together. That's my point, is that just
Right.
for perspective, everyone here, you got to realize if a broker is going to award you the deal and you just call them once, yeah, so many deals, they're like, who the hell is this guy with no credibility, no track record? Yeah, like, why would I waste my time doing that? Like, and also the other thing is too, is if you get a deal awarded to you and you put down that money, guess what? No one gets paid until they close. So no one feels cool or good about awarding a deal to someone who's not going to actually act on it. That is a risk. You want to work with people like Hunter, like us, and Tyler and Hunter, and Rob and I, Lone Star or ASYM, who's actually going to get the deal done, or a Rise 48 or an Ashcroft, whoever the household name you want to bring up. It is a risk not awarding to deals that are higher level sponsors there, because quite frankly, what's going to happen is, you're not going to close the deal and then it's going to go back. And what if market circumstances get worse? Well, now your client hates you and you've lost that listing and you're done and you're not getting paid, and you have a bad name because you chose the wrong buyer. So who you are and who you work with really matters. So just
That's
for
a great
perspective,
point, Craig. And if I could,
yeah,
if I could just like add a little finer
please,
point to that
yeah.
as well, is that because if you tie up a deal and then don't close on it, it's such a reputational disrupting sort of thing. Because at the end of the day, think about it from the seller's perspective or from another buyer's perspective. If somebody ties up a deal and doesn't close on it, and then it comes back to the market, the rest of the buyer pool out there are going to wonder to themselves, what's wrong with that deal? They're not going to wonder like, how come that person couldn't raise the capital? They're going to think the worst. They're going to wonder what's wrong with the deal. And then for the other people who are bidding on that deal, they're going to say, okay, like, yeah, I'm ready to make another offer, but I'm going to reduce it by half a million, 1 million, $2 million, whatever the number is. So yeah, not closing on a deal when you tie it up. It's one of the worst things you can do in the industry. So I highly recommend being very careful when you tie something up. Like, make sure you've got your equity in order, because you have to be able to execute.
Without a doubt. And it's funny. The best deals when you're on the acquisition side is when you come in second place and get the first phone call when the deal falls out and you're the second husband. This is one of the rare situations in life where you want to be the second husband here. Okay. Trust me, you'll probably get it for a lower purchase price. And if you buy a deal for $500,000 less or $1 million less, that actually basically means you just made $500,000 or $1 million there, because on the back end, you're going to reap that benefit when you sell it for more money, right? So I can't stress enough the two things you can never change. I'm going to say change it and change it. Or sorry, I'm going to hit this point once more. Location and purchase price. You can never change those two things. Those are the two permanents to anything. Debt, Financing, this, that will always be a variable topic. And what will be the best medium is up to kind of the beholder to choose there. But those are the two things you cannot do. So if you're working with a sponsor, or working with trying to buy, if you're someone who can't close, or you're a constant and perpetual retrader, basically changing the terms on a deal once you get awarded, that's also a faux pas in the business. Now, there are circumstances where market conditions, you can't control it. I mean, frankly, the last 2 years, I would say, is a slight variance to that rule, or probably the last year and a half, where treasury volatility has been so crazy. Interest rates are really predicated on treasury, 2 year, 5 year, 7 year, 10 year. So if that is, a consistent, thing, or nothing kind of happens to the property, this, that, if you're a retrader, that's a very bad look. So just for anyone who's aspiring partner, something like that, or someone who's looking to partner with people, do your due diligence on the sponsor. Do they close consistently? Do they retrade a lot? Do they have a good name? It's very important. There's a lot of people that do not have good names in this business. And if you're also a capital partner, capital allocator, looking to find someone to work with, looking for a partner, guys, you really need to be very smart and selective and vet who you are working with, because you don't want to waste all this time raising $1 million for a deal that doesn't end up closing. That is a waste of your time. Real estate is a performance business, a business that is based on closing, not doing the activity, but closing. It's unique, maybe in real estate more than any other business, where that's truly the most important thing is, did you get the job done? Did you close it? Did you buy it? Did you sell it?
Yeah, absolutely, Craig. And in fact, the we closed on a deal about a year or so ago. So we bought a deal back in September of 2023, and we weren't the highest bidder on that deal. We were actually $800,000 less than the highest bid. The highest bid was 19.4 million. We were at 18.6, and because of the kind of the collective reputation of the GP group, we were selected to take that deal down, even though we weren't the highest bid. So you're right. The reputation is so important. It's tough. We can't stress it enough. It's so important.
Yeah. So let's talk about the strategy in Phoenix, maybe where it started and where it's going, what's changed between now and then.
Yeah, absolutely, Craig. So at ASYM Capital, most of the multifamily investing that we've done historically, it's been more of your traditional value add sort of strategy, right? Where you're buying 70s, 80s, 90s vintage multifamily. You're kind of coming in, you're renovating units, just like your typical syndicator kind of value add strategy is what we've historically invested in. But one thing that's been very interesting in this market, Craig, is that, we kind of came into this market expecting that this would be what we would continue to do. But with the run up in 2021 and early 2022, we saw so many of those properties trade. I don't have the exact numbers off the top of my head, but I think it's like 30 to 40% of all of those kinds of properties all sold. And now here we are a few years later, and a lot of those deals are basically frozen. We've seen very targeted instances of distressed and for sellers, but it's not been very much. It's been very, very nominal. It's been very limited. And, in those situations, they're really tough properties too. Like they're C properties and C locations, maybe even D properties and D locations, older boiler chiller properties, so on and so forth. But long story short, a lot of those deals sold and they've been kind of frozen as people have tried to just kind of kick the can down the road and not sell for a loss right now. So for one, the transaction volume on that stuff is way down. Two, the numbers are tough to make sense when those deals do hit the market. For one, I'd call it kind of a flattening of the rent roll for those particular deals. And what I mean by that is that even if a sponsor an owner is asleep at the wheel, there's been some time for some of the loss to lease to burn off a little bit and catch up. We saw really high rent growth in 2021 and 2022 in Phoenix. So a lot of sponsors, if they weren't really diligent, they got lost to lease really quickly. Folks have had the opportunity to kind of catch up on that a little bit. But also we've seen compression between the rents for renovated units and unrenovated units at these buildings too. So it becomes harder to justify. Let's say that you're going to spend $15,000 to renovate a unit and you're only going to get a $75 rent bump to do that. The math just doesn't work in that situation, right? You need to be able to get more of a premium to renovate a unit. So that makes it more difficult. And then lastly, to renovate the unit, simply the input costs have gotten so much more expensive as well. Because if you want to come in and renovate a unit right now to a platinum standard in this market, you might be looking at maybe $15,000 to $18,000. And back in 2018, 2019, maybe you're looking at like $7,000 to $8,000. So for all those reasons, it's very difficult to get more of your traditional Class B value add multifamily to pencil. And it's hard to find those deals too. So because of that, we kind of pride ourselves, like you mentioned earlier, being nimble. We're nimble. We're not going to force our will on the market. We're going to very diligently observe what the market is doing, and we're going to take what the market is giving us. So what we've seen is, yeah, it's hard to find those deals. It's hard to do those deals, but we're seeing a lot more opportunities in the Class A space where you've got merchant builders who are eager to get rid of inventory. They're eager to build and at least get it partially leased up and get rid of inventory. And, if they can break even, maybe even take a slight loss or a tiny gain, they want to just sell inventory and live to fight another day. So what we've seen is, holy cow, in the new build space, in the Class A space, we're seeing a really exciting opportunity right now. We're seeing a really good price per pound where there's situations where you can buy some of these deals below today's replacement cost. And I don't think this moment's going to be here forever. Maybe it's another 12 months, maybe it's another 18 months, but we've kind of shifted our strategy a bit because it feels like this is the opportunity right now, that type of real estate. And because of that, we've had to do other things as well. We've had to kind of grow our equity relationships a bit because we can syndicate quite a bit of money. For us to take down a deal that has a $40 million equity requirement, we're probably gonna need some bigger checks in there as well. So we spent a lot of time building out our equity relationships and finding some good joint venture partners. But yeah, because of that, we're still looking at some of the older stuff. Like there are going to be targeted opportunities there. And when you're hyper focused on a single market like we are, you need to have some flexibility in terms of vintage, and you have to be willing to take some of those older assets when opportunities do arise. So we're still looking at it, but we think the best opportunity is some of this newer stuff that we're seeing right now.
Everything you said, I just want to put an exclamation point on and really just hyper focus. You are so spot on there. I love everything you said, and we are doing stuff similar to that. I think right now, we don't really know when the bottom is. I think we're really in it right now, if not, close enough to it. But if we're not at the bottom, the kind of question I ask myself is, well, would I rather own Class A real estate or Class C? Class C is going to have more crime. It's going to, obviously be hit by the recession pretty tough. And the market is still falling there. But Class A, probably a little higher in tenants, probably a little easier to manage, higher incomes, probably higher incomes equal, just call it what it is, higher quality people. Sorry, everyone. No disrespect to people who live in Class C, but the likelihood of lower crime is certainly a possibility there. So you can get into these properties that you own well, and these windows are going to open close. And Phoenix, funny enough, was the darling of COVID, ran up like crazy. I would argue that it was way too underappreciated and undervalued for a long time after the big GFC, both all the companies moving to Arizona, kind of California being a big net loser from COVID. It's really accelerated in growth and upside there. So I just find it to be very a fascinating kind of setup and circumstance that is Phoenix right now, but also where the opportunity lies. And it's funny to hear that you guys are doing a similar strategy to us. So, I guess, could you kind of walk through what a cap rate that you would feel comfortable kind of going into just as a boilerplate number, for you and your investors, what they're looking for and what kind of market is in Phoenix right now? Because I'd be fascinated to know that as a resident here as well.
Yeah, great question. And I'll talk a bit about the Class A space because even in Class A specifically, I feel like we're seeing some pretty wide variation right now, depending on where the property is located, the type of the property, so on and so forth. So I'd kind of break the Class A space into three different buckets right now. The first bucket that I would mention would be kind of your best assets in the best locations, sort of multifamily. So think of like, Scottsdale Quarter, Old Town Scottsdale, like best asset, Class A assets, best locations. That kind of stuff, I'd say you're probably looking at a going in cap rate in the high fours,
Right
maybe,
now.
yeah, maybe touching five. And then the next grouping that I'd say would be kind of more of your just like solid suburban Class A multifamily, better submarkets. Think like East Valley, that
Gilbert,
sort of. Yeah,
Chandler, yeah,
of course.
Peoria,
Yeah.
maybe if you're West Valley, Glendale, nice pockets there, you're saying?
Yeah, yeah, kind of more of like your just really solid suburban Class A multifamily. I'd say that's more kind of like low fives. And then the third group, I'd say it'd be more of like your third ring sort of location. So areas where maybe you're a little bit further out, maybe you've got high supply, maybe the demographics and the incomes aren't quite as good, for some of those deals, you might even be looking like mid to high fives from a going in cap rate perspective. So it really
Still
kind
very
of
tight.
yeah, yeah, yeah. So that's kind of what we're seeing kind of in the Class A space. Class B would be a kind of a tick above that third group for Class A, and then when it comes to Class C, it's a bit tougher to pin down. Just because the transaction volume has been so light, and that's another reason I'd say that we're just a bit more, and not to just like dog on Class B and C, because again, I think there are going to be opportunities there, and we're going to buy some of those properties. But in terms of like right now in the market cycle, on the Class A side, it feels, my sense is that we've kind of hit a bottom from a valuation perspective. Like the valuations feel like they're kind of firming up based on the transactions that we're seeing. Whereas the further down you get in quality, it feels a bit more ambiguous. And I don't know if we're at the bottom yet from a Class C standpoint, for example.
Makes sense. So I remember not too long ago, my friend was dating a gal that lived in the Scottsdale corridor area, which is north on Scottsdale Road, right below the 101. Not, it's probably, that area is called mid North Scottsdale, I would say, not North Scottsdale, not South Scottsdale, but kind of that range, right? And he was telling me how crazy it was because there was about 50 to 60% occupancy in like a 2020, 2021 built property, which is really crazy. That's a very big problem. That means that property, couldn't even size up for, agency financing, meaning you have to get bridge debt or private money debt or something like that, right? Which is very expensive and shorter term in length inherently. Are you seeing a lot of deals like that kind of come up that, need to be acquired in that structure, and also just newer building properties, generally speaking, needing a lot of concessions and having, massive occupancy problems right now?
That's a really good question, Craig. And there definitely is some of that going on. It's no secret that, in Phoenix, you're seeing a lot of supply coming online. It's not quite to the level of Austin and a couple other markets, but when you look across the Sun Belt, it's a fairly high supply market right now. It's a bit of a mixed bag. We definitely are seeing some of these lease ups that are doing some pretty significant concessions, sometimes up to 8 weeks. So we are seeing that. We are seeing some groups that are struggling a little bit on the lease up. There is some of that going on. We're seeing other ones too that are just kind of knocking out of the park, leasing it up, So it's a bit of a mixed bag. And when you look at the Phoenix market too, depending on what submarket you're in, there's going to be more supply. So, that's one objection that we've gotten recently from some people is like, hey, look, there's a lot of supply coming on in Phoenix. I'm just not so sure if I want to do that. And there are a lot of mitigating factors that I would point to in that situation. First of all, when you look at something like high supply, it's not like you're trying to predict interest rates, because Craig, and I know, like the interest rate forward curve, it's always wrong. The Federal Reserve, they're always wrong, right? Like you can look at data to try to predict where interest rates are going to go, but it's kind of tough to do.
We
When
all
you look
thought floaters would have been fine in 2021 and 2022 until they weren't.
Right. Yeah.
Yeah,
Yeah, exactly. But when you look at something like high supply, for example, we've got really good data to see where supply is going, and we can see it's going down and to the right, right? Like we're hitting the peak and it's going down from here. So when it comes to the high supply discussion, we're trying to find opportunities where there are pockets where there's less supply, and we're finding, and we're looking for opportunities as well where, what are the concessions currently at the property. If they're running 8 weeks of concessions, that's going to be a little bit scarier. But a deal that we wrote an offer on last week, actually, bit of a higher supply part of the valley, but they're not running any concessions now. A few months ago, they lowered the rents and said, look, we're just not going to run concessions. So they've already kind of reduced their rent roll,
they
and
found
they
that
haven't.
equilibrium, if you will.
Precisely correct. Yeah, they found that equilibrium, and they're not running any concessions, and they're holding serve from an occupancy perspective, and their trade outs are roughly neutral. So if you really kind of look a bit deeper, even though there's high supply in certain areas, you can either find opportunities where there isn't as much supply, or other mitigating factors related to specific deals that might make you comfortable with that specific asset.
For sure, that makes sense. Can you talk about some of the objections you get in your market? We obviously are a big player in Texas. Texas is no mystery here, and specifically Houston. It's hurricanes, flood zones, insurance costs, things like that. Phoenix, okay, it's funny. Cost per unit, very high. If you're looking at a deal in Phoenix and a deal in Houston, you're like, wait, or Texas, Dallas, San Antonio. I was like, why is this, 175 a door? And Phoenix, it's like, wait, this is $300, $400, whatever it may be, right? I don't know what the price per door is anymore, but insurance and property taxes are low. So every market is different. It's not always apples to apples, even though we're talking about the same asset class. So with that
Yeah.
said, can we talk about some of the objections that you deal with, and also the one that I remember a podcast that you and Hunter did about within a year's time, which was a podcast about Phoenix's water, which I'm sure that's kind of one of the big questions that you have. Well, what if it runs out of water, right? So I'd be curious to hear that side of the equation.
Absolutely. Yeah. Yeah. So we definitely, in terms of objections that we're receiving right now, supply, I kind of just covered. Like that's one thing that has people concerned. But again, I
That's
think
everywhere.
yeah. Yeah. And I think there's some mitigating factors that we can point to there that would make us comfortable overall, but more specifically on deals as well. Another objection that we received recently as well was that the deal that we did back last fall, it was a bit of an older vintage property. So it made the raise really difficult to be honest. It took a
I
long
know
time
that
for
feeling.
yeah, it took us a long time to get that one over the finish line. And yeah, people were as a mid 70s vintage property. But as I looked at that particular property too, there were a lot of mitigating factors that we really tried to explain to people like, hey, look, yes, it's a mid 70s vintage property, but it doesn't have boilers and chillers. That's a mitigating factor. The seller put $2.3 million into this thing and it looks beautiful. There's very little deferred maintenance. It looks really good from that perspective. There's just a lot of mitigating factors that we pointed to on that particular deal, and it was really hard to raise for. And, we're 97% occupied and 8% ahead of pro forma for year one. So like everything's going really well there, but I'm not sure if you guys experienced it, but on the older deals, I understand people's hesitation there, but I encourage investors to look for those mitigating factors and think carefully about it, because you might miss really good opportunities if you're dogmatic about vintage and simply, won't do a deal that's past a certain year. Because yeah, we had mitigating factors there. We had a huge CapEx budget just in case things went wrong. We had all this stuff kind of going on. So that was another one. And then from a water perspective, we don't get that one all that much, but we do get it once every quarter. I would say probably people get a little bit concerned with the water. And some of the high level things that I'd point to here would be, Phoenix is, and just kind of the whole Arizona and the whole valley they're very proactive around planning for water usage. They do these detailed studies that look out like 100 years into the future. And if there's any little shortfall in that, like for example, I know in one of the last studies they did, they're like, oh shoot, in 100 years we're going to be 3% short on water. So they undertook this process to develop like a $1 billion water treatment plant that's more than going to make up for that shortfall. So when you kind of start to like peel the layers back a little bit from a water perspective, you kind of find that I think it's much ado about nothing, but really a big clincher here as well is like, look, we've done our independent research and we've gotten comfortable. But you look at somebody like Taiwan Semiconductor, you look at somebody like Intel, Taiwan Semiconductor is building a $65 billion chip manufacturing facility. Intel's expanding their chip manufacturing facility by $20 billion
Everyone who
right
makes
now.
chips is literally coming to Arizona. So
Yes.
Arizona is going to be the chip manufacturing hub, arguably of the Americas, and it's really going to be Arizona and Texas.
Absolutely. Absolutely. And the interesting tie-in with water there too, Craig, is that chip manufacturing notoriously uses a lot of water. So,
Yes.
I mean, if you're building a $65 billion, chip manufacturing facility, you've got millions of dollars of research budget before you kind of go and do this. Like that's another mitigating factor where it's like, look, we didn't do that research ourselves, but if we've got some of the biggest, most sophisticated companies in the world making multi-billion dollar bets on an industry that requires a ton of water, that's something that gives us some comfort as well.
Yeah, I mean, the only recommendation I have about water is how you drink it. Okay, I do not drink any tap water in the state whatsoever. I have water.com and I have Mountain Valley spring water coming to my house, or I drink really that's coming up soon, but I've been drinking Liquid Death all the time. So, only recommendation I have with water is do not drink the tap water, even filtered water. And I don't know if you're doing that. I was going to tell you offline, but I'll tell you now. Please don't. Okay, I don't trust it. It's not that it's not fine and there's not enough of it to go around where there's an issue, but I just personally would prefer to not drink it and to taxes are very cheap here, cost of living here is very economical. Okay, So that's just the Arizona tax that you have there is, hey, you have to spend maybe $200 a month on water, but that's the smallest price to pay.
That's a fair point. Yeah. I mean, this water's, I mean, they do a great job of recycling the water, right? I mean, so do you really want to drink that recycled water? I don't know. But, just one last little data point on the water that I think is really interesting and just really kind of demonstrates how proactive the state of Arizona has been is that I believe it was, if you go back to the 1960s, I hope I get these statistics right. I can circle back for the show notes if I don't, but since the 1960s, the amount of water usage in Phoenix, the amount of water usage right now in Phoenix is the same as it was back in the
It's
1960s.
1980. No, it's
Okay,
1980. Yeah,
thank
it's,
you, thank
it's
you.
close enough, but I knew exactly what you were going to say.
Right, and you look at the population growth and the economic growth, like everything that's occurred since then, and we're still using the same amount of water. It's really impressive and really kind of shows the proactive nature of how seriously people take it.
Couldn't agree more. And listen, if you don't think that some of the smartest environmentalists and the smartest people in the world are contracted by Arizona to take care of this issue, you are miscalculating the intelligence of the state of Arizona and the planning here. Because if you're able to figure out how you can have a city in the desert, which before air conditioning was around was nearly impossible, I can assure you that you're mistaken because it is that important, obviously, naturally here. So
Absolutely.
yeah. So what would you say, just to kind of wrap up here, to kind of put a bow in the conversation, and thank you so much for coming on. What would you say the ultimate goal is? We're obviously in the resetting of the cycle here. I think almost anything you can buy will turn into gold. Should you buy, at an appropriate price, not the lowest, not threading the needle, but kind of in realm with ballpark, just from a cyclical perspective. Assuming you don't fall asleep at the wheel, you're going to make some money on it. But as we go through this kind of part of the cycle, where do you and Hunter see the vision of the company long term? Is it really high quality core stable deals? Is it threading the needle with value wise? Is it 10-year plus crystallization holds? What is your thought process on that?
That's a great question. And right now, like given the market opportunity that we're seeing right now, I could definitely see us buying a lot more of the core plus sort of stuff this year and next year, like the next couple of years here, like really kind of diving into that and acquiring as many of those types of assets that we can. At the same time, we're not trying to, we're very careful. Like this is another area where we see very eye to eye on is that we feel like in the real estate business, it's something that needs to be scaled very carefully and methodically. It's not the type of business that you want to just like scale to the moon immediately because you can get yourself in trouble that way. So we do want to acquire as many of those type of assets that we can, but how many can we reasonably acquire, like comfortably, like given bandwidth and just again being careful scalers of the business? It's probably 2 to 4 per year. If we can do about a deal per quarter here the next couple of years and scoop up some of these core plus assets while they're on sale, we'll be really excited about that. And then beyond that, it becomes a little bit more difficult to say because we kind of pride ourselves on being nimble and taking what the market takes us. So it might be the core plus stuff right now. It might be something different a couple years from now. But in terms of like the near term, like that's kind of what I see as like about a deal a quarter or so. Probably more of kind of that core plus sort of stuff. And then further out into the future, it might be a little bit more of a mix as the market starts to change a little bit and different opportunities start to come up. But that's kind of what I see here kind of in the next couple of years and kind of going into the future.
Do you have, I'm going to ask this, and usually sometimes I ask, I forgot to bring it up. Do you have any like hot takes for real estate that are contrarian or something that's maybe more personal to you that maybe the average person doesn't have?
Hot takes on real estate. That's a
Or
good
something
question.
that's a little bit contrarian or personal opinion or philosophy that you have that maybe others don't share, perhaps?
I guess one that I'd be willing to kind of yeah let's go there. I think I've
Yeah,
got one that might be I think I've got one that might be pretty good.
cool. All right, Tyler, thank you so much for being such a good sport, giving me an hour of your time here today. I'm sure everyone's going to love listening to this and learning more about you and what you're up to. So thank you so much for coming on. Final question. What is your hottest real estate take?
All right. So the hot take that I'll give you here, Craig, and this is something that we've observed here in the Phoenix market, and it goes a bit counter to a lot of the conventional wisdom that might be spoken about in the real estate industry. And it's something that's been a bit of a wake up call for me too, as I've kind of observed the market. But, oftentimes you'll hear people talk about how, Class B multifamily real estate is insulated from the new supply of the Class A. That seems to be just kind of like common knowledge and common wisdom in the multifamily industry. But I would argue that the trickle down effect is a bit more significant than people might anticipate, because what you have happen is that for the people who are the most qualified folks in those class B multifamily deals, you've got a lot of supply coming in line, and the rents in class A are coming down because there is that supply. They're offering concessions, they're reducing rents, so on and so forth. You are going to see a filtering up of the most qualified tenants kind of out of the class B and into the class A. So be careful. I think that's one thing that's conventional wisdom, that I don't know if that thesis is quite as airtight as people may have once thought. And now that we're kind of seeing a lot of Class A development coming on in a lot of these different markets, I think it's something that people in some of the Class B and C deals might be experiencing, and might be feeling some pain from.
Awesome take. I love it. It hasn't been heard here yet, so I appreciate the originality there. Tyler, you've been amazing. Where can people find you, get a hold of you, and reach out if they want to invest and learn more about you?
Appreciate it, Craig. This has been a lot of fun, man. I really appreciate you inviting me on the show today. It's a huge honor. If people want to follow me and ASYM Capital, the best way to do that would be to connect with me on LinkedIn. I'm fairly active on there. If you just search Tyler Lyons, it should be pretty easy for you to find me. And also, if you're an accredited investor or maybe a family office or fund manager, happy to have conversations about the amazing opportunities that we're seeing in Phoenix as well. Feel free to reach out on LinkedIn or email us at investors@asymcapital.com. I'd be happy to set up a call.
Thank you so much. For everyone who was listening to the show, thank you so much, and we'll see you next week. Peace.